Hello and welcome to Module 1 on bonds. We're now on topic 6 and we're going to be looking at different types of bonds. So in the previous topics, the examples have been based on bonds that are issued locally, as in South Africa by a South African company to the South African market. But that's not always the case. Bond issuers, companies can open themselves up to global investors. So a local company can very well issue a bond overseas that could even be denominated in other currencies like euros or dollars. And then also the type of coupon. In the previous examples, in the previous topics, we've been looking at fixed rate coupons, meaning where the coupon rate stays constant, meaning that the interest payment that the bond holder receives remains constant. But that's not always the case. You do get cases where the coupon does change. And we'll look at those type of zero coupon bonds or floating rate bonds. And then also, it's also the type of structure of bonds. So you do get different structures of bonds where some bonds are convertible, others are callable, but we'll explain that as we progress through the slides. So what we've been looking at so far are fixed coupon bonds. So for example, if you look at the slides, an investor would pay 1,000 rands. And let's say, so in this instance, it's let's say a 3-year bond that pays a coupon every year. Oh, sorry, in this case, it would be a 4-year bond. So while they hold the while they hold the bond, every single year, they'll receive a coupon. And in the final year, they'll receive the final coupon and the 1,000 rand that they've invested initially. And a fixed coupon bond means that the coupon stays the same. The coupon rate never changes, which means that the coupon size or the interest amount never changes throughout the life of a bond. And then we also have something known as a zero coupon bond. So this is a type of bond that doesn't pay any coupon at all. So typically these bonds are issued at what we call a discount. So whereas in the previous example, the bond was issued at 1,000 rands, this one would be issued at a discount, so slightly less, so say 900 rands. And then instead of paying a coupon throughout the life of the bond, at the end you'd get 1,000 rand as the maturing value. So if you compare it to the previous example, at the beginning of a fixed coupon bond, the investor received the same amount of invested capital at the end, whereas with a zero coupon bond, you pay a little bit upfront and you get more at maturity. And then you also get instances where the coupon rate floats. So when we say a floating coupon rate, we basically mean that it fluctuates. And the fluctuation is basically due to linking the coupon rate to some sort of reference rate. So for example, if we look at the Consumer Price Index, okay, CPI, that's the measure for inflation. It's possible to link a coupon to CPI. So typically how that would work is CPI changes over the life of the bond, and you would get a bond that pays CPI plus what we call a spread. So it would be CPI plus, for example, 2%. And whatever CPI is on the time, or at the time that the coupon gets paid, you add the 2% spread to it, and that gives you the total coupon rate that is used to calculate the coupon amount. And then when the next coupon payment is due, if CPI has changed, then what that means in effect is that the coupon rate would have changed. So every time a coupon gets paid, as long as CPI changes, we say that the rate or the coupon rate also changes, therefore it is a floating rate. And why would someone invest in a floating rate bond, or also known as a floating rate note that's linked to inflation? Well, it's basically something that you could use as an investor to protect yourself against inflation. But then another thing to remember, in this particular example, we're looking at where an investor would pay 1,000 rands up front and at maturity receive the 1,000 rands at the end. So the maturing value doesn't change. What changes is the coupon rate. And then other types of bonds that you get are callable bonds. So a callable bond is basically one that gives the company that issues the bond the option to redeem the bond before it matures. So basically what that means is, say for instance, a company has issued a 5-year bond. If that 5-year bond pays a coupon rate of 10%, but then during the life of the bond, interest rates decline, the company has the option to redeem those bonds in the market, and then it can, if it chooses, to reissue bonds at lower interest rates, which would pay a lower coupon. Or it gives another reason why a company would do it is also to be able to pay off its debt when it wants to or needs to pay off its debt. The disadvantage to a bondholder is that this is a form of prepayment risk. So for instance, if you had invested in a bond and you were looking forward to earn this 10% coupon for the next 5 years, then all of a sudden, when the company calls the bond, you're no longer going to be earning that coupon, which means that you need to now reinvest your money and possibly at less favorable rates in the market. And then another type of bond is a convertible bond, and that's when the issuing company has the discretion or the option to convert the bond into a certain number of shares. So what that means for you as an investor is that you'd be holding a bond that would be paying you a coupon. When the company decides to convert it into shares, then you automatically become a shareholder now of the company. And the disadvantage of that to you as an investor is that when you're holding shares instead of a bond, there's no maturing value as there would have been with a bond. So if you were holding a 5-year bond and you had paid 1,000 rands, you knew that at the end of the 5 years you'd be getting 1,000 rand back, your invested capital. Whereas there is no invested capital when it comes to shares. And also, the company is not obliged to pay a dividend if it didn't declare a dividend. Or if it decides to change its dividend policy, it can change its dividend policy. And also, as we covered in previous modules, in previous topics, when you look at the risk profile between shares and bonds, shares are riskier instruments than bonds. So effectively, the company has the right to convert the bond into a riskier instrument for you. And companies would possibly do this if maybe they no longer wanted to be paying coupon payments. Then they could convert to shares. And then index-linked bonds. So we looked at an example where you had a floating rate note or a floating rate bond that was linked to CPI, which is the Consumer Price Index. But there are other, so the CPI is what you'd call a reference rate. So an index-linked bond is basically one where the coupon rate is based on some sort of reference rate. And there are other indices that can be used as a reference rate to which, or that can be used to calculate your coupon. And then also international bonds. We talked about it very briefly, but that's basically where a bond issuer in South Africa could open themselves up to raise cash offshore by issuing bonds in foreign markets denominated in foreign currencies. So a local company issuing a bond in, say, in Europe, denominated either in euros or in dollars. And that is all for this topic. If you'd want more information and more examples, do go online and download the training manual. It would have more worked examples and more information. Thank you.